Diganth, I want to start with the fundamentals and foundations, right? So that people are able to understand what exactly an ESOP is. If you can explain what exactly is an ESOP and how is that different from, let's say, getting a salary or a performance bonus?
Got it. See, ESOPs fundamentally is a right to own equity at a future date. It is not, shares given to you today or anything of that sort. Right? A lot of people have the misconception that, hey, if I have ESOP, I have shares in the company directly. No, that's not the case. When a company gives you ESOP for, let's say, whatever amount, they could be like 10 lakh, 20 lakh, 30 lakh rupees or a specific percentage of the company. They're basically telling you that, hey, over time or when these specific milestones are met. Now, those milestones could be years past or quarters past or specific performance metrics of you or the company being hit. Certain portions of this amount that we're saying we're going to give you, that right to own that in the form of shares will be unlocked. Now that right unlocking that event is called as a vesting period, and that entire period when the entire right of all the amount is unlocked is called as a vesting schedule, right? So that's a vesting term. At the end of that, you have to actually pay the company some money called as an exercise price and then get shares. Only then are you a shareholder, right? So it is a right to own equity in the company. Well, salary is actual cash. Salary, if you tell someone, hey, I got 2 lakh rupees, then you actually got 2 lakh rupees in the bank. But if you tell someone I got 2 lakh rupees worth of stock options, that means that is a right to own. Now, whether you have those 2 lakh rupees or the stock options today or they're going to get vested over time is another conversation. But that is the basic distinction. You have a right to own equity in the form of ESOP. You have actual cash in the form of salary or bonus.
Yeah. So what you're essentially saying is ESOP is not equity itself. It's an option to own equity in a future date, right? That's
100%.
fundamentally what ESOP is, right? You also touched upon some of these key terms, right? In that. So in my mind, there are three major events that are three key milestones that happens in the life cycle of an ESOP from an employee perspective, right? There is a grant, there is a vest, and there is an exercise. Could you make it clear to the audience on what each of these three events are?
Sure. See, grant is basically when an agreement is signed by you and the company. So basically, that is
at the offer letter stage when somebody
it could be at the offer letter stage, it could be at the appraisal level stage, it could be sometime in the middle of the year. So basically, grant is when the company officially gives you a document saying, hey, Rijas, this is the amount of stock options we're going to give you. This is how it's going to vest over time, which I'll explain what vesting means. The right unlocking, essentially. And from that day onwards, a specific clock will start. The moment the document is signed, the vesting will begin. So that is what a grant is called. Right? Until a grant letter is given to you and it is signed by you and the company, you don't really have stock options. Anything sent over email, anything sent over WhatsApp does not mean anything. An actual official grant has to be made, and this grant is made through a format which is a document which has everything stated. Who are you? What department are you in? What stock options? From which plan? What is the exercise price? What does the schedule look like as a table? All of these things have to be specified. It has to be signed with the company. It has to be signed by you. This entire activity of getting that signed is called getting the stock options granted, right? And the company has many things to do in the back end, but that is what grant is. Vesting, like I mentioned to you, when your right to own equity unlocks over time, right? That each stage where it gets unlocked is called vesting, right? You have vested interest now in that potential right. Till then, you don't have anything. So if you leave the company or for whatever reason you are no longer a part of the company, whatever has not vested, so whatever right has not unlocked, is sort of wavered. So that is lapsed. So whatever is unvested usually gets lapsed when you leave the company. So vesting is unlocking of the right in simple terms. Exercise is basically you exercise that right to own equity. You now have that unlocked right. Whatever right has been unlocked, the locked right you still can't exercise, but the unlocked right, you pay the company a specific amount called as an exercise price. And then the company transfers the shares for that, right? So if let's say if you have 10 stock options that you are now exercising or unlocking or exercising the right to own shares, you'll have to pay 10 stock options into a specific exercise price per stock option to get that many number of shares. Now that could be 10 shares if it is a 1:1 ratio, or if it is, let's say, a 5:1 ratio, then you're probably going to get 2 shares for 10 stock options. So depending on that.
Is it a fair understanding that grant is actually a promise that the company is making that we will allocate something like this for you in the future? Vesting is where you are getting the actual option to own it, and exercising is when you're actually owning the equity. Is that the right understanding?
Yes. Perfect, right? A company promises to give you with many caveats. They promise with many caveats. Vesting unlocks that, yes, now then you can actually exercise the right to own equity. Once you exercise, you're a shareholder of the company. Now then you're an official shareholder, till then you're not.
So even if something has vested and if you haven't exercised it, you don't own the equity,
You
right?
do
That's
not
the
own it.
bottom line. Perfect. Got it. Now, thinking of it from the perspective of a potential candidate who's evaluating an offer, right? What are the key terminologies, numbers that somebody will have to look for while evaluating an offer letter?
See, the first thing that I would look for when someone says, hey, I'm going to give you this amount of stock options, firstly, the amount. What is the rupee value today or the USD value or whatever value that is, right? So what is the actual tangible value that you're going to get? Second is how many shares would that equate to? And for that, you'll need to understand what is the fair market value today of the company based on which you're giving that. Third would be what percentage of the company would this be on a fully diluted basis? Fully diluted basis means after everything is converted and then as allotted shares are there, right? So based on that, what is going to be your fully diluted stake in the company?
Would a company be okay with disclosing all of these things to a
Ideally,
potential employee?
should be, right? So, and that is the kind of mindset we are trying to change as well with the kind of education that we're providing through our platform, right? So the company should be okay with sharing this information. Why? Because the company is essentially telling you, hey, I'm giving you equity for which you're going to invest your time and effort into this company. So I'm going to give you equity which is going to make you feel, I'm going to give you the right to own equity which is going to make you feel like an owner of the company, have more skin in the game, which would then translate to you putting more effort. So there is upfront risk with the amount of effort you're taking. And in many cases, you're even withdrawing a potential cash component for that ESOP. A lot of people negotiate with, so you are
Absolutely.
investing money. So when you're investing money, so if someone is with sort of letting go of 10, 20 lakh rupees worth of actual potential cash, usually for CTCs, 70, 80 lakhs, about 20% of that or 20 lakhs of that would be in ESOP. So that is 20 lakh rupees worth of investment they've put into the company. So when you're investing 20 lakhs into anything, you're going to do due diligence. You're going to ask for that information, right? So even if you were to write an angel investment check of 20 lakhs into a company, you would ask for these things anyways. So it is the employee's right to know these things, right? But they're
So you
not.
mentioned there is an overall value of the ESOPs, then there is a vesting period,
Yes.
right? Then there is a fair market value,
Yeah.
right? Is cliff also something to be considered while people are evaluating an offer letter?
Yes, the cliff period.
Okay.
So apart from the number of shares and what percentage of the company you would own on a fully diluted basis, then you got to know the cliff period. So cliff period basically means that if you leave the company at any point within the cliff period, anything that is vested as well goes away. So nothing gets vested. And in India, the statute is that at least 12 months is the minimum cliff period. So it cannot be less than 12 months. So mandate is that any stock option within 12 months, if you leave the company, you don't get anything. Even one day before the 12
Oh,
months.
that's a mandate by
It is a mandate. You
by the.
cannot reduce that time. You can't make it 6 months,
Alright.
8 months, 10 months, 11 months, even if you want to do it, right? A lot of founders do want to do it. A lot of founders do make the mistake of promising stock options 8 months back and not creating a stock option plan. And then they come to us and say, hey, we want to create a stock option plan. We promised it 8 months back. But then we have to give them the hard pill that, hey, listen, but if the employee leaves in 12 months, those 8 months worth of potential vested stock options are gone as well. So vesting cliff period is important. It should ideally be not be more than 12 months because listen, you're getting a reward by the company. Why put a lock on that? Okay. Post that, what is your vesting schedule? Is it going to get vested annually? Is it going to get vested quarterly, or is it going to get vested monthly? That you need to know that. What that means is, if it is annually, then another 12 months, only once that passes will the next tranche be unlocked. That is, in the next 11 months you leave, whatever is the extra that you are supposed to get, that gets completely lapsed. You don't get that as well. But if it is on monthly basis, every month that you continue to stay in the company post the cliff period, portions of the stock options will get vested. Right? So you need to know that. Then you'll need to know a few more things. So what I also sort of recommend a lot of employees to do is to do due diligence in the company before they invest into the company. So they need to know specific, like I told you, right? You're investing in the company, you're letting go of cash. So when you are negotiating with founders and they say, hey, sorry, we can't share that with you, the first statement is going to be, but I'm letting go of 15, 20, 25 lakh rupees worth of cash for this stock options. How can I not know these things? You need to know what is your runway of the company, how much is the company raised, what are the company's milestones before they raise the next round, are they doing well, what is their burn rate? All these things need to be known by the employee beforehand, because many people think of it in silos. They think, okay, I'm going to assess the grant letter in a silo and the company whatever happens to it happens. But how the company performs and what the company's tangible performances are over a period of time is what will define if you're going to get an exit for your stock options, there'll be a buyback for your stock options, or if there'll be takers for your stock options if you want to sell it later. So these things need to be assessed along with your ownership percentage, along with the cliff, along with the price to be shared, and all of that, right? Final thing, you'll need to know what is the share price today. Like based on the FM, what is the share price today? That will help you assess that if I would exercise everything today, this is the amount of tax I would end up paying, right? And then you will need to understand from the company, okay, when you ask those questions of when you plan to raise your next round, or what do you think the valuation of the company is going to be in 4 years and why it would be that, then you should assess, okay, based on maybe how many fundraising the company will have, what will my additional dilution be? What will the rate of increase of the share price be? Which will then tell you what your potential future fair market value of your share could be.